India just released its first act or its first bill on cryptocurrency taxation, and I know a lot of confusions are there. We don't know how to react. We don't know what this 30% and 1% TDS means. So in this today's video, we discussed what this bill is, the intentions behind this bill, which I see, what my analysis say, what government is trying to do, and how they are trying to monitor the cryptocurrency activities within exchanges, within investors, etc. So this is going to be the whole crux of this video. My name is Vikrant Mansera. You can also call me Vico. If you are new to the channel, please subscribe to the channel below. Please also click on the bell icon. Yeah, so let's jump on to the official memorandum which has been released in the budget, and let's see what it clearly says. One of the best part which I liked about this memorandum was it starts with that virtual digital assets are gaining tremendous popularity. So one thing is good, India is recognizing cryptocurrencies as an asset, and also it recognizes the popularity it has gained in the recent years. We already know we have more than like 13, 14, 15 million people in India who are already trading or have already invested in cryptocurrencies. The amount of flow of capital which is coming into this country, especially in the cryptocurrency markets, tremendous. But yes, the government knows they can't ban the cryptocurrencies. So yes, the regulation is the way forward. What the regulations say, what the bill say, let's jump onto the statement. It clearly says the income tax payable shall be the aggregate of the amount of income tax calculated on income of transfer of any virtual digital asset at the rate of 30%, and the amount of income tax with which the SEC would have been chargeable had the total income of the SEC been reduced by the aggregate of the income from transfer of virtual digital asset. I'll tell you in simple words, in very simple words. Whatever your income, your net income in a financial year is, using cryptocurrencies, you will be charged flat 30% on that. I see there are many websites that are writing, yes, there are capital gains, then there are business incomes, there are long-term, short-term. We don't have anything. We don't have information on anything yet. Right now, the bill clearly says whatever your net income is in a year, you will be charged flat 30%. Now the question comes, how is this net income calculated? I'll tell you in simple words. You take your money or your INR amount, you deposit it on an exchange, you buy cryptocurrencies using that, then you sell it, and then you get your money back into your bank account. Whatever is the net change will be the net income. Please remember the technicalities of this net income. I deposited 1 lakh rupees in, let's say, CoinDCX exchange, right? Now I bought bitcoins using that. If at that point of time when I deposited or when I bought bitcoin, the price of bitcoin was, let's say, 50 lakh rupees. Now when I'm selling my bitcoin, let's say if the price of bitcoin has dropped to 25 lakhs, that means my 1 lakh rupees is now how much? It's just 50,000, which is half the amount. So I am at a loss of 50,000 rupees. If I sell my bitcoin to INR and I deposit my 50,000 rupees worth of INR at a loss of 50,000 to my bank account, yes, then I'm at a loss. Do I have to pay any taxes on that? No. Let's say the price of Bitcoin from 50 lakhs, it goes to 1 crores. The amount I invested, 1 lakh, how much is it now? It is 2 lakhs. So I am at a net profit of 1 lakh rupees. Now how much tax do I have to pay to the government? 30% of the net income, which is 30,000. Simple, right? Till now here everything is simple. However, no deduction with respect to any expenditure other than the cost of acquisition or allowance or set off any loss shall be allowed to the SSE under any provision of the Act while computing income from transfer of such asset. Now see guys, I am making this video not only for the retail crypto investors, I am making this video for every person who is in this cryptocurrency community. And I want them to understand, let's say if you have a staking node, right, and you spent thousands of dollars to set up a staking node or a mining node or a miner. In this cases, you are receiving rewards. You're receiving on-chain, blockchain-based rewards for the governance or for the validation you're providing to the blockchain. These assets may be either coming to you from the treasury of that blockchain foundation, or maybe the new cryptocurrencies are getting mined. The rule will consider that yes, in your wallet, you received some cryptocurrencies and now you converted those cryptocurrencies to INR. The entire income will be considered as net income and you have to pay 30% taxes on that. If you receive airdrops, if you receive, for example, in the crypto community, there are so many competitions and contests and trading competitions. You receive prize money in cryptocurrencies. Now, if you go out there and convert those cryptocurrencies to INR and deposit money in your bank account, you have to pay 30%. I know it's harsh, it's very harsh, but this is for now what the rule is saying. 2.2, which is very important. No set off of any loss arising from the transfer of virtual digital asset shall be allowed against any income computed under any other provision of the Act, and such loss shall not be carried forward to subsequent assessment years. For example, you had a profit of 50,000 rupees using virtual assets. Now you are having a loss of, let's say, 20,000 rupees from your other sources of income or from your other assets. Your net profit will not be 30,000. No, it will not be 50,000 minus 20,000. This is the nature of this bill. The government is treating virtual assets exclusively. They don't want to merge the treatment of virtual assets with any other assets, with any other source of income, with equities, with commodities, with gold, anything. No. They have created a bill, and also I think they have some sort of investor protection in mind, that they are treating virtual assets very exclusively. And this shows that why and how this bill is still in its very naive stage. A lot of things need to be added. An act or a bill is passed by the parliament, and then later a whole comprehensive set of rules is formed around that bill, which is formed by the central government. After that bill has been passed by the parliament, then the set of rules will be formed. Right now, this is just a bill and a lot of things are still missing. Cryptocurrency industry or cryptocurrency sector is a huge sector in which there are lots of incentivization mechanisms. There are lots and lots of ways how funds are being transferred from one wallet to another wallet. So I think it will grow with time, but right now let's understand what this 2.2 means. No set off of any losses arising from transfer of virtual digital asset, and also it shall not be carried forward to subsequent assessment years. Now what does this mean? This is a very important sentence. Now let's say you are in year 2022 to 20, you invested 1 lakh rupees in 2022 and you invested 1 lakh rupees in year 2023. Now let's say its value is now 50,000. This value is, let's 1,25,000. See what is the net gain and loss. Here you are at a loss of 50,000 rupees, right? But here you are at a profit of 25,000 rupees. The sentence 2.2 clearly states that if you are at a loss of minus 50,000 and here you are at a profit of 25,000, your is not this plus this. No, it is not. Okay, please remember this thing. It is not this. This loss of 50,000 will not be carried forward to the profit of 23-24 or any other year or any subsequent years. If you have had a loss of 50,000 rupees in year 22 to 23, you have had it. The loss is there. You don't have to pay any taxes on this amount because you are at a loss. But since you have made a profit of 25,000 rupees here, you have to pay a tax of 7,500 in this year. If you are at a loss of 50,000, fine, you don't have to pay any taxes. But if you are at a profit of 25,000, you have to pay the taxes of 7,500 here, the 30% of this amount, whatever your net income or net profit is. If you are making profits, you pay the taxes. If you are making loss, you don't pay the taxes, but your losses will not be carried forward to the next year. Now, when is this tax amount being calculated? Only when you have bought the cryptocurrency and then also sold it and received that money, that INR money, in your bank account. If you have not sold, then there is no tax. If you, let's say, you're holding this, your 1 lakh worth rupees of Bitcoin to year 2025 to 2026, and now the current value of Bitcoin is, let's say, 2,75,000. Now, what is your net gain or loss? Or let's say, how much tax do you have to pay? Your net gain is again this minus this. In your taxes, you have to show at what initial price, what was your cost of acquisition. So you have to show the government that your cost of acquisition of that Bitcoin was 1 lakh rupees, and now you're selling it for 2,75,000. Your net profit is 1,75,000, and your taxes will be 52,500, which is 30% of this amount. Now the question comes, the amendment will take effect from 1st April 2023 and will accordingly apply to the assessment year 2023 to 2024. For assessment year 2023 to 2024, the financial year will be 2022 to 2023. That means if there are any cryptocurrencies which you are selling after 1st April 2022, the net income will be taxable. And it doesn't matter if you have bought those cryptocurrencies at any point of time. You have to show the government what your cost of acquisition is, what your net gain and loss is. If you are at a net gain, you have to pay the taxes. It can be completely possible that, for example, you bought Ethereum in year 2016 for $100, and now you're selling your Ethereum at $4,000 after 1st April 2022. You are at a net profit of $3,900 and you have to pay 30% to the government. There is no rule which says when your cost of acquisition was, or your cost of acquisition should have been after a certain date. There is no rule like that. If you are selling your cryptocurrencies after 1st April 2022, you have to show the government what your cost of acquisition was, and you have to pay the taxes on that. Now there's a rule there which states, in order to widen the tax base on the transactions, it is proposed to insert section 194S to the Act to provide for deduction of tax on payment for transfer of virtual digital assets to a resident at the rate of 1% of such sum. However, in case the payment for such transfer is wholly in kind of exchange of another virtual digital asset where there is no part in cash, or partly in cash or partly in kind, but the part in cash is not sufficient to meet the liability of deduction of tax in respect of whole of such transfer, the person making the payment shall ensure that the tax has been paid with respect to such consideration. Why this rule has been proposed? I'll tell you why. Because the government wants to monitor each and every crypto transaction and trading activity on these exchanges. Now think from the exchange's perspective. An exchange is a place which is bringing a buyer and a seller together. Now when my order is getting placed on an order book, and for example I decided to buy BTC at a price, there is also a person corresponding to that price who is ready to sell BTC at that price. Now exchange is a place which is bringing buyer and seller together. Now because of this TDS rule, exchange is in a position where exchange has to charge 1% TDS to me who is buying BTC and selling USDT, and also 1% TDS to the seller who is selling BTC and buying USDT. The trading fees on exchanges, I believe, are definitely going to increase, and this is something, and it is slightly complicated, which the exchanges only have 4 to 5 months to incorporate in their infrastructure. What happens if I'm selling my USDT and buying Bitcoin from an individual and not from an exchange? Now in this case, I again need to have the PAN card of that person. If I'm selling my Bitcoin to other person and taking either USDT or INR, I need to have the PAN card of that person and I need to charge TDS. That person who has bought Bitcoin from me can show the receipt of that TDS in his tax document, that yes, he has paid a 1% TDS to me. And again, this is the case of peer-to-peer exchanges. Think of the margin trading, where people are trading 5x, 10x, 20x leverages. Will they be able to trade with that freedom? No. This rule is, it looks like this rule is created by the government to only promote long-term investing and not trading. Government doesn't want people or traders to take advantage of the market's volatility. They only want the government to trade, take advantage of a long-term capital appreciation of these cryptocurrency assets, take those profits, come out and sell it. This is why again they have this rule that you cannot carry forward the losses. They don't want you to sell your cryptocurrencies at losses ever. They only want you to sell at profit, and they want to take a part of profit as a tax. Now this says in 3.1, it says in the case of specified person, the provision of 203 and 206 AB. I'll tell you in simple words. In case the pair is an individual or an HUF, their turnover is less than rupees 1 crore, or their salary or their compensation from their profession is less than or equal to rupees 50 lakhs, or having income, which is this second point, there is no liability to deduct any taxes. By this tax I mean only TDS. In any case, the sell limit is proposed to be rupees 10,000 during a financial year. Now this amendment will take effect from 1st of July 2022. March, April, May, June and a little bit of February. So the exchanges in India, they have somewhere nearly 4 to 5 months to implement this TDS rule, this 1% TDS rule into their trading infrastructure, because again they are going to start charging 1% TDS on every crypto transaction or on every crypto trading activity. Government wants that whatever you are trading, you trade on these licensed exchanges with your PAN card being tied to your exchange account. They want to monitor your cryptocurrency activities. This is their way, as government in their very initial days also mentioned, they want to monitor your trading activities. Why? Because they are very much concerned about money laundering and terrorist financing activities. So this is why they want all the trading which you are doing, you do on these on these exchanges, these major exchanges, and government will monitor these activities based on your PAN card. Now the fourth point. The expression property shall have the meaning assigned to it in explanation of clause 7 and shall include virtual digital asset. Again, in simple words, taking effect from 1st April 2023 and will accordingly apply in relation to the assessment year 2023-24 and in all subsequent years. If you are receiving cryptocurrencies as a gift, you have to pay 30% tax on that. Again, the cryptocurrencies are being treated exclusively. They are again being treated as, let's say, a lottery. Even if you're receiving cryptocurrencies from any person, you have to pay 30% tax on that. It's simple. If you are sending these cryptocurrencies to your, let's say, brother, sister, father, mother, grandparents, what the prima facie is, you should not be charged 30% if you're sending cryptocurrencies to your blood relations. This is what usually the case is with any other asset or any other, even money. If you, for example, if you send some money to your sister to buy a gift, or let's say buy a phone, then it is not tax deductible. So in the case of family, or in the case of these blood relations, it should not be taxable, should not. As I mentioned, if you're receiving airdrops, if you're receiving staking rewards, if you are receiving liquidity pool rewards, for example, you deposited some money on a DEX, on a decentralized exchange, in a liquidity pool, you earned some rewards, you brought that amount to the exchange, You converted that amount to INR. Now you have to pay 30% tax again on the net profit you have made or the net earnings you have done using those liquidity pools. In cryptocurrency industry, we usually have these passive sources of income. Usually there are liquidity pool rewards, airdrops, staking rewards, etc, etc. Now all these rewards which you are earning, they're all going to be tax deductible. Now, right now, as I mentioned, this is just a bill, and there are variety of things which still need to be discussed. Something as simple as if you are earning less than, let's say, 5 lakh rupees, you don't have to pay any taxes in your income. But if you have invested in cryptocurrencies, and even if you make a profit of 500 rupees, you have to pay tax. You will need a CA, or you will need a person who can file taxes for you. So this is what my analysis say about this bill. This is the first step, the very first step, the very primary step to introduce cryptocurrencies as a digital asset to the entire country. The tax rate is so high, which is at 30%, is because the government wants a small part of investor protection to be intact in this law. They want the investors to realize that yes, cryptos are highly volatile markets, and if you are going to trade and if you are going to take that amount of risk in these highly volatile markets, you have to pay high taxes. So they are trying to keep away these very risk-averse investors who don't invest in highly volatile markets. As we see, there is no mention at all of business income or capital gains or small and long-term gains, or if there should be a differentiation on the nature of assets you are holding. There is no differentiation at all. It is still in its very naive stages. A whole comprehensive set of rules will be formed around this bill, and which we believe is going to be in a very positive direction. Some of the positives which I see from the bill is, yes, more fintech players are going to emerge in the cryptocurrency industry. The banks are now going to start partnering with the cryptocurrency platforms. Everybody in the whole ecosystem is going to benefit. It is going to produce lots of jobs. It is going to bring lots of FDI into this country, and the whole ecosystem is going to evolve and expand. First thing. Second thing, the institutional investors in India are going to rise. The institutional and enterprise platforms in India, especially crypto-based platforms, are going to emerge. They are going to mushroom at a very fast rate. We will see many financial services coming which will be very crypto native. Let's say insurance, collaterals, lending and borrowing, crowdfunding like ICOs and IDOs. Again, we don't have any rules specific to ICOs and crypto-based crowdfunding. Again, we need a rule for that as well. I won't be surprised if these major exchanges which are present outside this country, let's say Coinbase or Binance or FTX, KuCoin, Huobi, they start coming to India to take advantage of this emerging growth of investors in this country. And they have massive infrastructures. They can incorporate laws, 1% TDS rule, which the government has proposed. They can easily incorporate these changes. What I see based on the nature of this bill, as I mentioned, the government is trying to promote long-term investment. So maybe platforms like SIPs in cryptos, they will gain a lot of advantage in the future, because the investors and the traders will want to invest in cryptocurrencies for long term. Nobody wants to pay taxes again every year, and that too when your losses cannot be carried forward to the next year. The trading activity on the exchanges might go down, because again, if I have to pay 1% TDS on every trade, it's painful. People in this country might be forced to use DEXs instead of centralized exchanges, because again, I don't want to pay 1% TDS. I'm still fine paying a small amount on a DEX which is built on Solana or Phantom or Terra blockchain. Definitely not Ethereum. I can't pay that amount on Uniswap. I can still pay for the DEXs on Polygon. So the DEX, the on-chain activity might increase. People might start learning to use DEXs. They will trade there. They will bring back the earned money back to the exchange wallet. And again, they charge tax only when the amount will be converted to INR. the next part, we are going to see a massive surge, a massive growth of on-ramp solutions. I see in the coming months it is going to become super easy for you to deposit your INR in your bank accounts from your exchange wallets and vice versa. The on-ramp solutions in India are going to massively scale. So yeah, these are a few things which we need to remember. If you have any other questions with respect to this crypto tax, crypto bills, etc., please send it to me. Please write it in the comments. I will do an Instagram live as well to answer all your questions. For now, that's it. It was great talking to you. I hope I have covered each and every point which has been discussed in this bill for now. There will be more things coming in the future. We will definitely keep an eye on that and I will keep you updated. But for now, yes, this was the crypto tax bill which has been proposed in this budget 2022. And keep investing, keep researching, invest with understanding. Thank you. Namaste.